Well, good morning, everyone. My name is Roger Scott. I'm the head trader for Wealth Press, and today is, believe it or not, it's actually July 1st. That's right, it's July 1st. I don't know where the year has gone. It's just amazing. It's just time just flies. I don't know if it's kids, if it's busy season, it's because of the COVID-19 and all this stay-at-home stuff, but I don't know where time is flying. But it's July 1st. I got a big thing. I think this month I think we're going to see a little cool off in the stock market. We're going to be a little more defensive. I'm seeing gold prices rise. I'm seeing potentially upside in the bond market. But let's talk about global markets, and I'll tell you about the two pullback stocks that I'm looking at right now. I'll show you how I found them and why I like them. So global shares dipped on Wednesday. The Dow is opening about 150, 200 points down. Or at least it appears this way, with investors more cautious after major indexes closed their best quarter in years. Remember, it's a rebound effect, folks. It's a reaction, and I've explained that by using momentum levels. The second quarter gains were the best since 1998 for Wall Street and the largest since 2015 for Europe, as hopes for an easing of economic lockdown spurred market confidence. Keep something in mind. When they say second quarter gains were the best since 1998, that's based on revisions. They're actually some of the worst numbers, but they have been revised and the expectations are meeting the actual numbers. But these are the best numbers in light of the COVID-19. These are not the best numbers on an absolute basis. So make sure you understand that, all right? Wall Street has a way of fudging numbers as well. And this is a very, second quarter gains were the best since 1998. Yeah, because of what happened. Look at what the expectations were. We were expecting a positive 8% earnings, and we're like down 25%. So you got to look at this with a big grain of salt. Economic indicators were mixed Wednesday, with a quarterly Bank of Japan survey showing manufacturers' sentiment plunged to its lowest levels in more than a decade as pandemic crushed export and tourism, mainstays for the world's third largest economy. And these things are not getting any better anytime soon. That's what's scaring me, which can turn a medical downside in the stock market, what started off as a medical, into a full blast economic slowdown. And that's what I'm afraid of. A separate survey showed China's manufacturing activity improved in June. That's great, adding to signs of gradual recovery from the country's deepest economic downturn since at least the mid-1960s. And I think that's a fair estimate. Similar survey for the 19-country Eurozone showed an improvement in manufacturing in June, with the industry almost growing again after the shutdown. Analysts said that while the data pointed in the right direction, it shows that economic recovery from the pandemic will be slow. Oh yeah. Surge is confirmed in new cases, which has prompted European Union to bar U.S. travelers from entry. We've seen this before, and we're seeing it again. Is seeding doubts that the economic recovery can happen as quickly as the markets had forecast. That helps explain why markets momentum cooled in June. We've been sticking right around the 200-day line. Beyond the COVID-19, analysts also pointed to upcoming elections and other risks that could upset markets. If Democrats sweep Congress and the White House, which many investors see as a possibility, it could mean higher tax rates, which could weaken corporate profits. And I want to say something about that. That can usually, when we have the election cycle, the summers tend to be volatile, and then September and October leading into the elections tend to be very calm. So usually traders are expecting a calm summer, but usually on the election year, everything gets pushed forward and the summers are actually quite volatile. And then we see a slowdown around the middle of September, October, and then leading into the election. What I am happy about is crude oil. Crude oil is now above $40 a barrel. This is a very positive sign because this means that large producers and refiners in this country, in U.S., are going to be not losing money. They pay roughly $40 a barrel. So up till now, they've been losing money. So finally, they can get to break even around the $40, $42 a barrel, and things can be looking higher. We still need quite a bit. If the cost of crude was about $50 a barrel, 55, it would be substantially better. But I'll take whatever I can get. At least they're not bleeding money really right now. So that's the global news. Let's look at the stock market. Let's look at the S&P 500. I want to show you the 200-day line. And as you could see here, we're kind of just sitting, treading. I wouldn't really pay too much attention into the last 3 days or 2.5 days because this is a fragmented week. We've got a holiday. We've got 4th of July weekend, holidays, markets are closed on Friday, and that means that volume is retail. Institutional traders stay away from fragmented weeks. There's just not enough volume on Wall Street, and large hedge fund traders look at that as an excuse to go on holiday. So again, I wouldn't put too much attention into this trading action, but again, we're sitting near the 200-day moving average and we're not bouncing. And momentum levels, as I showed you over the last several days, look at this. Percentage of stocks in the overall stock market, 36%. Folks, the stock market is bearish. There's only 54 or 64% of stocks, 64 are trading below the 200-day moving average. If you look at the S&P 500, you will see the 39%. And if you look at it on a long-term basis, and I want to show this to you because, again, these things don't lie. See that? We went up, 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 up. We went down. We crashed hard, and then we've been coming up, and then we're coming down. So sentiment is looking lower. Stock market is looking a little weaker. Gold prices, look at gold prices, are coming up. They're moving higher, folks. Gold is near a multi-year high right now. Look at that, multi-year high. This is 2011. Look at this, multi-year high. We're at the highest price that we have been since 2013 right now. So we are definitely moving higher on the gold market. And if we're moving higher on the gold market, that means it's time to get defensive. And because of that, if you look at the stock market, over the last several months, you will see that technology has been leading, and it still is, on a relative strength basis, on a 6, 3, and 1 month basis, and on a 1 month basis. But I believe we're going to start getting defensive. And as a result of that, I want to look for pullbacks in healthcare stocks. All right. And there's two that I'm liking right now. And let me show you those two stocks. One is NVO and one is SRPT. Let's take them separately. Let's look at NVO. Now, this stock is a insulin diabetes care manufacturer. Again, not much impact from the stock market. I'm trying to get away from consumer discretionary buying, and I'm looking to put money in July in sectors that are not dependent on the economy. Healthcare stocks are more dependent on the government, on grants, on Fed, on interest rates. The overall economy doesn't have as big of an impact as it does on consumer discretionary and healthcare, and that's why I think we're going to be moving higher on these stocks. So I would wait for a little more downside. I would wait for the RSI to move to the oversold territory. That would be when it moves to 30 or lower. Still not there yet. I would wait for it to maybe move to the 61 level, right where it's above the 200-day line, but below the 50-day line. I call that the twilight zone. And then I would wait for it to come back up above the 50-day line. So I'm looking for it to come down and then come back up, and I'm looking to buy around the $65 level. But I'm going to look to buy when it's above 65. And that's my number one pullback trade. How did I find this trade? Very easy. 90-day high, 10-day low. 90-day high, 10-day low. Write this down. 90-day highs, and sometimes 90-day highs can be multi-year highs. See that? So 90-day highs, and in this case it happens to be an all-time high, and then 10-day low. 90-day high, 10-day low. 10 lowest trading session of the last 10 days. That's how you find pullbacks. 90-day high, 10-day low. The code is right here, right there. 90-day high, 10-day low, and moving higher at the end of the day. The second stock I like is SRPT. Let me show you this one. Sarepta Therapeutics. Again, it's pulling back. Notice the RSI is midway. I want to see the RSI at the 30 level, which would probably cause the price to go right to the 140-ish level. Again, wait for it to break the 50-day moving average and then buy it on the way back up when it breaks higher. So we want to see it come down. We want to see the RSI go to 30 And then when it comes back up above the 50-day moving average, we want to buy it. And again, the stock is making a 90-day high and a 10 trading session low. Let me look long term. Long term, the stock is near all-time highs. I love these 90-day breakouts because they allow me to look at the stock and find the stock on a good basis. So again, 90-day high, 10-day low, and it's rallying higher. And if this stock doesn't give you the opportunity, don't worry about it. You can miss it. But again, I'm looking for the RSI to go to 30 before I make my strike. What I'm looking for is stocks that are going really strong, like really, really strong, and pulling back. Going really, really strong and pulling back. So again, these two stocks, ticker symbol is SRPT, and the second one, ticker symbol is NVO. This NT DOI I'm not happy about because liquidity is low, and I don't like stocks with low liquidity because options usually have 10 times less liquidity than the underlying asset. So I like to stick with stocks that have good liquidity. Look at this, about 2 million, 1 million. That's all good. Remember, we're not day trading, and I like these pullbacks that are going from 90-day high to 10-day low. 90-day high, 10-day low. NVO, SRPT is the ticker symbol. And folks, remember, we've got FOMC today at 2 o'clock. So don't load up your boat. I like that. Don't load up your trading account. Keep your exposure at about 30% of your regular positions till we get out of the FOMC. And then tomorrow we have jobless claims and employment data. So I'm expecting volatility and volatility to pick up a little bit because institutional traders are staying on the sidelines and retail traders are going to come in tomorrow, and with liquidity lower, they can make some noise. So be wary of that. Now, I hope you've heard of the money magnet effect. Have you heard of the money magnet effect? If you haven't, it's because Wall Street doesn't want you to. That's right. But you see, this strategy is the only way I know how to profit off the $5 trillion force that's about to swallow the markets, making every current trading strategy potentially obsolete. The only way to defend yourself is to use the money magnet effect to your advantage and potentially earn weekly payments of $1,056. How about $3,852? If you're interested, I'm revealing all the details about the strategy today. Click the link below to see how you can use this trading system and how you can add it to your toolbox and gain a major unfair advantage from the current market cycle. You got to check out these money magnet effects. It's the coolest thing ever. Tap into the $5 trillion force. Check out how you can make gains of $1,056, $3,852, potentially even more. Click the link below to see how you can use this trading system now. I'll talk to you guys tomorrow, and have a great day. And be careful. The market's going to get really choppy around here because it's the holiday week. Bye.